Okay, good evening, everyone. My name is Yisroel. I am here from the JCON conferences, welcoming you to the 6th Annual Real Estate Summit. Our lineup for the keynote panel this evening is a blockbuster one, and you have people who are titans in their industry, and some of them are also just great and funny personalities. So if I can quickly introduce our panel. Our moderator is Henry Stimler, who needs no introduction from Newmark. Henry, let's give it up for Henry. Madison Capital, Josh Zegen. A former star who came back again for the second year, Betesh, Meridian Capital. And Yisroel Berg. Welcome. This is your first year, but you'll get a great reception. Let's give it up to Yisroel Berg. Tonight's evening will be moderated by Henry Stimler, so without any further ado, Henry, the mic is yours.
Good afternoon, everyone, and welcome. I hear we have to make a small public announcement. We have to thank Shia Rubenstein, Jeff Grossman, Joe Grossman, and Mr. Berg. Thank you very much for arranging this so far. Looks like a fantastic crowd. Should we get everyone to move in rather than stand on the side and talk? Guys, let's move in, take a seat. You can yabble later.
We want to have a successful event, so if I can please ask everyone to refrain from talking, sit down. And I do also want to give Joe Grossman a wonderful shout out for arranging tonight's speakers. Joe Grossman, where are you? Stand up. And Sam Beer, his partner. Up. If you're looking for any off-market deals, they're your people. Okay, back to you, Henry.
Okay. All right. So today we're going to have a very lively discussion. Obviously, we're in a very turbulent market. It's nothing like last year where everything was a hunky-dory, everything was amazing. There are challenges, there are peaks and troughs in life, and sitting up in front of you, you have three of the best in the business. So hopefully we can glean some insight, not only of how to navigate business this year, but also how they achieved their great success, so we can really learn both from the past and also learn towards the future. So without further ado, let me give a little introduction to the panelists. We were meant to have one more panelist, but unfortunately he couldn't make it. So I'm going to start with Josh Zegen. Josh runs Madison Realty Capital. Today I would say they are the #1 lender for construction in the company. Josh has originated and loaned over $24 billion since his tenure. He started his business with his college roommate right out of school and built a small business into a behemoth of a business. So Josh, very excited. Thank you very much for being here. Yisroel Berg is someone that I interact with every single day. Everyone knows who Harbor Group is. Harbor Group is synonymous with excellence, with building an unbelievable company. Yisroel runs acquisitions for Harbor Group. He has risen up the ladder with great speed and great skill, and they are one of the most active buyers even in today's market. So we're going to get great insight on what type of stuff they're buying, why they're buying it, how they're doing it, and that's going to help other people emulate that and copy that. And finally, last but not least, Betesh, broker extraordinaire from Meridian. And lovely to have you, Morris. Does a tremendous amount of business. So we have a broker, a lender, a buyer, and myself, a moderator. So we've got 4 Jews in a bar. Okay. So guys, come sit down. Guys, come on, come in. You can yabble later between Mincha and Maariv. Let's go. Let's go. Okay. So what I'd like for the panel to do is, I've given a brief introduction, but I think it will be very helpful if all of you can give a brief introduction, and along with your brief introduction, talk about the last 3 deals you have successfully closed. So Josh, give a little introduction on yourself and Madison, and then the last 3, I know we're closing a $300 million deal next week, but so we can't talk about that, but talk about the 3 of the last deals you've closed, and the bigger the better.
Sure. So we closed a deal in April, which was with the Ritz Hotel and Residences in Paradise Valley, which was a deal, it was a $585 million loan. The project was about 80% complete. It had $300 million of hard contracts and sales. but the borrower really ran out of money and needed money to complete the project. So we came in to provide the money to finish the project, and with the amount of sales that were in contract, we would be paid down within 6 to 9 months or so. So that was an interesting, I would say it's a special situation deal combined with the completion of construction. The challenge of any deal that's mid-construction is you have to figure out cost to complete, what was done, what wasn't done, what's in contract. So that's a very interesting deal that we closed in April. We also closed the Ritz Residences in Palm Beach Gardens, which closed in May.
What was the size of that deal?
$340 million loan, and that was a brand new project that is substantially sold in Florida. In Florida, one of the unique things about Florida is you can use deposits for your equity. So when someone signs a contract to buy a unit, they put down a substantial amount of that deposit, and that can be used in combination with debt to fund the project. So that was another project we completed, and we're actually closing a deal in the next week, which was a very large home builder in Orlando, is selling about 600 homes that are complete or nearly complete, and our buyer and our borrower is buying the properties. We're providing a $240 million loan on a $400 million capitalization for single-family for-rent housing in the Orlando area.
So, amazing, but I think you should also talk about what is Madison's core competency, what your main focus is, and how much money you have to deploy.
So we started our business in 2004. We were one of the first in private credit. The word private credit really didn't exist when we started the business. And it started out as a smaller business with my college roommate with myself. That first fund grew to $300 million between 2005 and 2008. Global financial crisis happened, the market changed, and we really had to reinvent ourselves at that time because it was a very challenging market. Since then, the business has really grown substantially. Our last fund was $2.1 billion, which we closed at the end of 2021, and we're on our next fund right now. But the business has been a focus on special situations, completion financing, buying performing and non-performing loans, and lender finance. So we finance a lot of other alternative lenders as well through A-notes and loan-on-loan financing, and especially today, as banks have pulled back with the banking crisis, we've filled the void of a number of banks that are not funding deals today because of bank balance sheets sort of shrinking, the deposit base shrinking, insurance companies becoming a little more conservative. So we've created this niche in providing credit to other alternative lenders because no deal really works without a senior leverage point in the deal. So it's been a big opportunity for us in the last couple of years as well. The leverage of the lenders through loan-on-loan financing and A-note financing.
Last question on your introduction. What do you believe you'll deploy this year in terms of loans? How much money will you put out in 2023?
So we did, I would say in 2022, we did about $3.5 billion of loans. This year it's going to be somewhere between our 2022 volume and 2021 was $6 billion of loans. So probably $4 billion or so.
Which is very positive because people tell you everywhere that transactions have come to a halt and no one's doing business. You're completely against that. Obviously, you're going to deploy $3 billion in capital, in lending, so people are still very active.
Well, what we're seeing is, obviously, transaction volume is down substantially, and there's less players out there competing with us today. So there's less volume, but there's a lot less competition out there as well. So it's created an opportunity for us to sort of fill this void in the market with, in many cases, less leverage and higher sort of return profile than when we did in, let's say, 2021.
Yes, you're taking advantage. Yisroel, I can tell it's the last 3 deals, but I'll allow you. If you could give a brief, even though Harbor Group needs no introduction, can you give a brief introduction to what Harbor Group is and the last 3 deals you closed?
Yeah, sure. So, as the case with Henry, you got some of the details, right? Not all the details. But anyway, about Harbor Group International, we're about 20 billion AUM today. About 2/3 of that is multifamily oriented, and then within that 2/3, about 75% or about 12 billion is owner-operated direct equity. So that's about, today almost 60,000 apartment units that we manage, own and manage across the country. The balance on the multifamily side is debt-related instruments. It's going to be securitized debt. It's going to be preferred equity and mezz. We launched a credit fund recently where a lot of the capital is coming directly out of that credit fund. And so we're pretty active today by virtue of those sources of capital. What I would say the last three deals, maybe I won't do three exactly. We'll do kind of one debt investment and one equity investment. Everything we do today, just given the environment, needs a value proposition in some way or form. Obviously, we're not kind of trucking along anymore where we could, NOIs are just up, or we have a stable debt market where you could land. So really everything we're looking at, whether on the debt or equity side, needs to have a value play. We're on the equity side, what we're particularly focused on is new product. We think that in particular, buying things that are right at very early stage lease up, or just literally at TCO or slightly beyond that point. There's really a good value play. In a lot of those cases, those are trading below what today's replacement cost is. So most recently, we closed on a deal. Newmark was the sales broker and also did the financing on a deal called Russell & Lockland. It's a $105 million deal in Palm Beach County. We bought the deal for about $375 a door, and given we're active in the construction space as well, know with a fairly good level of confidence that kind of replacement cost today would be in the 415, 420 unit range. And so that's something that we're actively looking at, and something that we're being able to transact on. On the debt side, I'd say on the newly originated side, it's we're not as cavalier in some cases as Josh is here. We're
We'll say opportunistic, not cavalier.
We have newly originated side, it's definitely on the lower end from a volume perspective, but what we actually did, which is fairly attractive, we bought a mezzanine loan in the secondary market at a discounted, a pretty healthy discount to par, a really safe place in the capital stack, and kind of was able to convert something that had like a low 9 coupon on it to a gross yield that was kind of 10.5 plus. And so something really attractive in the debt space, and again, really kind of leaning in that value play in either place in the capital stack.
Thank you. Morris, we all know Meridian, we all know what Ralph has built. We have great respect for what he's done and what he's built and what he continues to build. You're a top producer there. Can you tell us a little bit about Meridian, what you do there, and something about the last few deals that you've closed?
Sure. So Meridian Capital is a commercial mortgage broker, and we have the benefit of basically working with Yisroel when we need to, Josh when we need to, and attempting to compete with Henry when we can. But so 3 deals that we recently closed, I think, are indicative of where the market is today. We closed a $78 million construction loan last week in Queens for a ground-up multifamily project. What was interesting about this deal is, generally speaking, I think if we were 2 or 3 years ago, we probably could have got one large bank to sign up the transaction and take down the whole thing. On this deal, just given the volatility in the banking market, we had to piece together a 3-lender syndicate. So we brought together 2 banks and a mezzanine lender to ultimately get the whole transaction done, which takes 3 times as long, but we're still able to get them done. Another one that we closed last week, also indicative of sort of the current climate, was a package of 3 industrial buildings in the Philadelphia region. We're representing an institutional private equity industrial fund who acquired these loans using their warehouse facility to just take them down, and they wanted to put permanent debt on them. So we got a national life insurance company lender to basically put 7-year fixed rate debt on these at 180 over treasuries, which was very attractive. At the time, we actually had only 2 bank offers, and this should have been, it's a $29 million transaction. It should have been a local bank deal, but at the time, all the local banks were sort of running for the bills. Nevertheless, we were able to find an insurance company to get that sort of deal done. And then one we closed just today is a hotel loan in Queens. It was a $40 million transaction. We closed, the hotel opened about a year ago. Lucky for the owner, the hotel market in New York City is actually back tremendously if you're actually operating a hotel and not leasing it to migrants.
It's also a very good business.
Well, there's a ton of supply offline, right? So there's really no more competition in the market. The amount of available rooms for visitors to New York to actually rent that are not occupied by migrants has decreased substantially. So if you're actually operating a hotel, your cash flow is significant. And so we're able to take advantage of the current cash flows, execute a non-recourse CMBS loan for him. He's got a 5-year IO transaction cashed out, has a $25 million loan in place, cashed out $15 million, and puts it away for the next 5 years.
Okay, so we've established the pedigree of the panel, each one in their own individual markets. Now let's talk about the market. Betesh, come sit down, guys. Or stop yabbling or go outside. We came all the way to Staten Island for this. Okay. You don't live here? No, I don't live here. Okay, so you have to be living under a hole to not know what's going on. Interest rates have gone through the roof like a rocket ship. Lenders have gone out of business, SVP. Signature Bank are no longer, huge institution mainstays are no longer in effect. We are facing tremendous turbulence on the multifamily sides. Rents are declining or plateauing, expenses are through the roof, and taxes are also through the roof. On the lending side, many lenders have pulled away, gone, and on the brokerage side, transactional volume, they say, is down by 75%. So we're all facing our own challenges. Yisroel, let's start with you. What would you say is the largest challenge you're facing in this current market, but also where do you see the opportunity?
So you kind of hit on a few of them. Obviously, the obvious answer is going to be interest rates, so I won't necessarily cover that.
Interest rates is the main reason we're feeling all the pain.
Yeah, exactly. I'll focus more multifamily specific. I think there's really kind of, two things, at least from my perspective, from a headline standpoint. One is supply.
What do you mean? What talk about supply? Oversupply. So, talk labor.
This year, between this year and the next year, as supply, I mean new deliveries. So kind of any major market, over the last couple of years, obviously financing was cheap. Land and construction has kind of skyrocketed from a development perspective. And between the next 24 months, there's over 1 million units delivering, call it in the top 150 markets in the country, which 150 is a big number, so that's going to expand to some secondary and tertiary markets as well. And so obviously with that large of a number, you're really going to start to see absorption go in the other direction. And so we've been in a market where demand has been through the roof on the multifamily side. I think long term that's not necessarily going away. However, when you factor in 6, 12, 18 months, and oftentimes, right, when you buy a deal, those early points of the deal are critical, especially now where, you're really struggling, for debt service or whatever, maybe if you're facing a high interest rate, there's a key for occupancy, and you're going to start to see some pressure by virtue of a lot of supply coming in. So that's certainly one item I think to focus on. Although multifamily fundamentals, kind of where the opportunity is on that end, multifamily fundamentals as a whole are still pretty positive.
It's the darling of the asset classes, right? Multifamily is going to be the best asset class of all the different asset classes. You don't want to be in office, not that office is bad, office is bad. You prefer to be, I'll be told not to say office is bad because we work as a leasing broker, so office is okay. But multifamily is still very strong. So we've got occupancy issues, but there's obviously opportunities because you guys are incredibly active. So you spoke about it very briefly in the introduction, but you're seeing the opportunity in buying new build multi, which you're getting well below replacement cost. But then how are you giving a return to your investors when you're buying with such high leverage on the new build multi? Is there a return to be made, or are you incubating that return, looking towards when you sell it in a few years' time and then going backwards?
So I think what we're doing at Harbor Group is kind of taking a step back here, and I think it used, over the last couple of years, real estate had become kind of a multiple play really quickly, and you can kind of, buy something, spend a few dollars, and cap rates are going to compress at 50 to 100 basis points in the 12 to 18 months that you owned it, and you could really kind of flip, make a really big profit. Historically, kind of the way real estate had kind of played is much more a cash flow oriented business, and something that you would own over time. Obviously get the benefits of appreciation, but also over time, increase in value slowly and moderately, and eventually have an exit at a positive number. So when we're buying today, everything is getting longer term fixed rate financing, call it 7 or even 10 years financing, which is available today by the agencies at attractive rates, trying to focus on buying positive leverage, so you're not kind of under day one, and then just hold for a longer period of time. And with, like I said, short-term fundamentals, there might be some pressure from supply, but long-term, you're definitely seeing, multifamily, like it's a darling, but it's a darling for a reason. Which people need to live somewhere. Housing, in most cases, the number one cause for move-out is home purchases. Home purchases are probably, the single-family residential is probably the one class that's being hit even harder by the interest rates. I think yesterday, a 30-year mortgage was about a 7.25, which was the highest in a decade. And so that really is pushing people towards renting. And so hence longer term, there is a good outlook there. And if we kind of shift our mindset from making a quick buck on the multifamily side to medium to longer term, there's healthy yields that can be.
So basically, going back to the basics, we were drunk on the last 6-7 years of insane cap rate compression. You bought a property, you didn't really have to do a lot of work with it, and it just kept on going up in value that you could turn around and sell it to the next guy. Those days are effectively gone. So today it's a much longer play, so you would recommend always locking in longer term fixed rate finance. Great.
Again, I wouldn't recommend, because everything's asset by asset and opportunity by opportunity. We have situations where we assumed a floating rate loan for whatever reason. But the view from our perspective to manage risk is to be, kind of medium to long term, is how I would say it.
Josh, you did, let's say 2 years ago, I don't know, $5-6 billion of loans. All of those loans are floating rate loans, are they not? Because you're in a construction lender predominantly, so you're lending floating rate loans. 2 years ago, SOFR was at 10 basis points. Today, SOFR is at 5.5. So the same guy that started this project 2 years ago is now paying a ton more interest to you. So you must have a lot of exposure because of the run-up in SOFR. So what are your challenges you're facing, and where, you also touched on seeing the opportunity of coming in at the end, but where do you see, first let's deal with how you're mitigating that problem, and how you're dealing with that problem, and then where the opportunities for you in the lending space are. Obviously banks have pulled back, but you've been incredibly active, so there must be a ton of opportunity that you're finding.
Start, I would say in 2021, a lot of the projects were at a point in the life cycle where construction costs just went up dramatically. So who your sponsor was really made a big difference. A lot of the institutional sponsors have been able to plug the gap with some additional capital, and a lot of times there's an additional 10%, 15% of proceeds needed to kind of fill that gap. In some cases, we've been bringing in preferred equity and mezz to kind of help plug the gap with the sponsor coming in with some additional equity if there was a budget bust. In other cases, the sponsor was able to plug that with other properties they were able to cross. And again, having a knowledge of construction development has really been sort of one of our advantages to really understand a project, completion, timeline, cost of carry. But no matter what, the interest rate carry going up 500 basis points has made an impact. From our 2021 underwriting, in most cases on rental housing, the numbers have exceeded sort of our projections in terms of rents.
So rental growth has offset the climate of interest somewhat, okay?
And from a cap rate standpoint, we really never assumed sort of the 3 to 4 cap exit. We were typically assuming a 5 cap kind of exit.
So your underwriting was not aggressive?
Not aggressive, and today that 5 is probably not necessarily a 5. In some markets it is, but in many markets where you see some volume of transactions, it's a 5.25, in some cases 5.5. So there's been some offset of rents to offset some of the increase, but in many cases the whole has to be plugged by additional capital coming in from equity or preferred in mezz, which we've sort of helped to facilitate.
But you're not doubling down, you're making introductions to other mezz lenders, or you're actually funding the mezz yourself?
I mean, one example, we had a couple of New Jersey construction loans on rental housing, and some of them were 2020 buys, 2021 buys. They were bought very well, and in one instance there was a lot of equity in one project, and we said, you know what, why don't we cross these two, we'll up our loan a bit, we'll come in with some additional proceeds, and that's how we solved that particular deal. And these are generally very good, like New Jersey has been a very good market for rental housing. Rents have exceeded our expectations. Supply has been relatively
The number one growth in the country is New Jersey at 7.1% rental growth.
Right. So that's the example of that. But also, look, having experience, we've had 20 years of experience in the business. We understand workouts, restructures. Also, when you're in a construction loan, you can't really stop. It's very hard to just completely stop because you really have to understand where you are in the project and to be really a solution provider to get things done.
Yeah, you can't stop because you've got all your money, you're funded by the project, so if a guy can't finish the building, there's no way for you to get out. So you're basically a partner with the developer.
You're not a partner, but you have to know when to stop, when not to stop, when to service it a certain way. I mean, that's give as many opportunities and chances as possible, and look for additional capital to come in. And that definitely is a profile of things that happen from some 2021 deals. In other cases, borrowers did exceed expectations, got things done quickly, got things rented quickly, and sold.
Right, so I think that's where the opportunity is. When you have a guy that can't complete his construction, he's run out of money, doesn't have the money to keep going, you're there to help him to get the deal over the line.
Yeah, one thing, we typically service everything in-house, and that also gives us a greater ability to really understand the project. We today service about 150 loans. It's a $12 billion book. So again, that really gives us a greater understanding and mindset to be able to service directly rather than through a third-party servicer. So we've had a big advantage doing that.
Very good. Morris, Meridian has done a tremendous amount of business with Signature, NYCB, Santander. Signature being gone must have left a large gaping hole in your armory, because predominantly New York buyers and New York brokers should have put together with the banks. Signature going under has caused all the other banks to pull back and kind of go into a shell. And also, as a broker, you feed on transactions. So it's pretty much a perfect storm in the brokerage business. You've lost some of your major lenders, you've got a huge decrease in transactions. Are these the challenges you're facing, and where are you seeing advantage as a broker to take advantage and get business and deals done?
Sure. So as a broker, our job is to find the right source of capital for every deal. And the best brokers are able to manage through challenging markets with changing environments. So I just mentioned 3 transactions we closed in the last 7 days. One was a CMBS lender, one's a life insurance company, and one's a syndicate of 2 banks and a mezz lender. And so that's what it takes in this market. You can't be complacent and just keep going back to the old community bank you used to go to. They're there.
You've got to work. You've got to put the work in today and cast a very wide net.
Yes, it takes. One of our mutual colleagues told me that this is like doing manual labor, although I'm not sure he's ever done that. And so it is challenging, but it's also very rewarding. And frankly, from our perspective, I think our clients need us now more than ever, right? So our value proposition to clients is higher than it's ever been. We're doing a tremendous amount of business. It's clearly less than it was in the prior years, but there's plenty out there to get done if you're aggressive, creative, and thoughtful, and able to empathize with your clients when things go a little sticky.
So it's basically, and I can say the same thing because we're both in the brokerage business. A year ago, you'd have a deal, you'd send it out to 3 or 4 lenders, you get 3 or 4 term sheets. Today, you've got to send it to 50, 60 lenders and hope that you get 2 term sheets. So it's just about turning over every stone and finding the right lender and casting a right net. Where is the opportunity? There's many guys in here that are brokers starting off in the brokerage capacity, coming into a very tough market. Thank God we're still doing a great volume of business. How are you doing the number of business? You go 3 deals, I would say about $500 million of those deals. Are these existing clients? Are you working with new clients? How are you taking advantage of this very tough market?
So I'll add another layer. Where in this market, you can't send a deal out to 50 lenders and get 2 term sheets. You have to call on those lenders, find them in their basement, scare them out of the hole, and explain to them why this is the deal they should pay attention to and take to their credit committee. Right? Everyone is a little bit more skeptical, a little bit more fearful, a little bit less willing to transact, and mailing in a deal to 50 lenders doesn't work anymore. So so brokers who can call on their relationships, leverage their relationships, push people to pay attention to transactions that have merit, can be successful. And to your second question about would younger brokers looking to break into the business, I mean, I think it's as good a time as any to break into the business because every relationship is up for grabs.
Yeah, and you said that on the car right here. This is a great time to be a broker because people aren't that busy, right?
Yeah, I mean, look, in a down market, it's the best time to build new relationships. And if you look back, when I look back at my career in 2009, we built some of the best relationships that we still have today. When things are hot, no one has time to talk to you. They don't need the solution that you're bringing to the table. In a tough and challenging market, it's a great opportunity to build new relationships.
Yeah, so people have kind of a draconian view, they're depressed that deals aren't happening, it's not as frothy as it was last year, but I think you've got to look at the silver lining, you've got to use this time really smartly, because a year ago, we were doing 40, 50 deals, so no one had time to chase business or talk to new people. Now people have time, so if you bring something unique to the table, a unique energy, a unique perspective, a hunger, people have the time to listen to you and you can really forage and make really great relationships out. You've always got to see through the clouds and see the light at the end of the tunnel. Okay.
Yeah, I mean, the only thing I would say is that you have a market that went up for 14 years. So you also have a whole personnel in real estate that don't necessarily have the experience to deal with the issues today. And a lot of people and borrowers and developers are sort of a deer caught in the headlights right now. So there's no sense of urgency, there's no sense of acting, and all of us, for the most part, haven't seen rates go up 500 basis points in a year.
Yeah.
But the last time rates went to these levels, I mean, in the early 90s, there was a big step up in rates, in the early 80s, but it's been a long time.
And in the last 2 months, we took a 90 basis point swing. How difficult is it? You put a deal under contract, thinking you're buying a 5.5 cap, you're borrowing at 5.5, and all of a sudden now your borrowing cost is 6%. That's pretty crazy. How are you mitigating that risk with these crazy swings in interest rates? You as a buyer, you're mostly affected by this. You as a lender, it's not the end of the world because you're a lender. But as a buyer, how are you navigating these incredibly choppy waters that, frankly, I've been in the business 5-6 years, I've never seen this kind of movement. I've been blessed like a lot of other people who came into the business at a good time. We've seen 7 years of good, now we're seeing 7 years of disaster. How are you dealing with these huge swings in interest rates?
Yes, this really started, June of last year, where you started to see their initial run-up of treasuries, and so it's really been, everyone's saying last year, but last year was really kind of when you had all this volatility really start, and some of those larger swings started to happen. I mean, the reality is there's no way to truly insulate yourself from that type of spike. I mean, if there's no turnkey solution other than to stay disciplined, and at least from our perspective, we won't go hard on a deposit until our rate is locked into a fully indexed lock. I would say 36 months ago, that would be different. I mean, you kind of understand what your band is, but you certainly, may not have to actually be index locked. So one form of a mitigant is obviously that. I think what I can say, in about 12 months last year, we had a pretty active year. The second half of the year, we purchased almost $1.5 billion of direct deals, mostly larger deals. I mean, each one of them, in some capacity was formed to have a conversation with the seller for an adjustment given rates. And so I think going into deals, understanding that, being fully transparent, how you're underwriting deals, how the rate and proceeds are going to impact your price and how you're looking at that deal, and having that communication with the seller is the best way to kind of, front-facing deal with it. It used to be everything's yes, we'll do whatever you need.
And the sellers understand that if you have a 40, 50 basis point swing, that your original price doesn't stack up, right? That's going to happen across the board. But also, I think today, if you're selling a deal, you want to sell to someone that has the money. Today, the syndicators, it's very hard to raise equity. It's very hard to find people willing to put money. So my father always says, a bird in the hand is better than two in the bush. So if you have a real buyer that is a little bit lower in price, but they have the money, it's sitting there, it's ready to go, but then you have another guy who's a syndicator offering more, I'm always going to go with the guy that has the money.
Right, but the key is in the transparency. I don't want that to get lost here. I mean, it's the idea is to clearly, define the terms that are allowing you to move forward at X price. And if those terms change by virtue of, the indices moving up 30, 40 basis points, then the seller kind of knows it's happening. So that's, that's a form of this. And again, I think deals that ultimately close, people are happy with. And last year, kind of, and through this year, honestly, through the last 10 days, where you dealt with a big spike, I mean, that's the approach with it.
Now it's kind of, Josh, what are you advising, I don't know if you call them partners or clients, guys that you've lent money to, especially on the big deals, what are you advising them in today's market, and what advice would you give someone, be it in development, be it a buyer, to navigate this market? What is the advice you're giving your current clients, and what advice can you give the room about how to navigate and be successful today?
What we're telling people, a lot of times, again, as I said before, a lot of people haven't really experienced this, and people are just waiting, and they're not getting any benefits just waiting. There's a lot of people that are just sort of stuck, they don't know what to do, they're not executing, so it's very important to really push the execution, whether it's to sell. In many cases, they look at the equity and say, look, I'm not going to get as much as I once got, but the reality is rates are where they are. It's probably going to last a lot longer than all of us expect, and you got to act. You get more liability.
More is lost with indecision than decision.
Yes, especially in development, construction. Absolutely.
I would just, to tag on to that, it's even being proactive before the problem necessarily kind of faces itself.
Yeah, and I always tell our clients, don't go into a shell. When things are bad, we have a tendency to kind of hide under the desk, be in the fetal position. Be communicative. If things aren't working out with you, if things are problematic, talk to your lenders, talk to your brokers. Don't hide, because the problem is not going to go away. As you said, interest rates are going to be here and higher for much longer than we anticipated. This is not a short spike, this is a longer spike. The worst thing you can do is don't communicate. Morris, you must be having a lot of clients turning to you for advice. What is the advice you're giving your clients, especially guys that bought in New York, that have crazy costs, crazy rules, crazy laws, crazy politicians? How are you guiding your clients right now?
I think there's a consensus amongst a lot of our clients that interest rates are going to come down. But what I tell people is, like, if you're making a bet that something's going to get better in the next 3 to 6 months, that's probably extremely risky. I think you have to think about things 2 to 3 years out. So, for instance, if someone has a land loan and they're in the market for a construction loan, they might not be happy with the construction terms that are available today, but they'll say, oh, wait another 3 months, see what happens, wait another 6 months, see what happens. Nothing really good is going to happen in 3 to 6 months, probably only going to get a little bit worse. But if they have the ability to shelve a project for 2 years or 3 years, that might be a rational decision. So I think the advice I'm giving people is, it's not a great time to transact, it's painful for everyone. If you can put something away for the medium term, that makes sense. But if you're trying to delay a little bit, you're probably going to end up on the wrong side of the tree.
And just to add on to that, many times, especially when you said you want to rate lock and then go hard, many times your guys going hard and saying they're going to play the treasury game. Oh, treasuries are going to go down, I don't want to rate lock, I want to be exposed, I know treasuries are going to go down, and ultimately they're always wrong. Treasuries have not gone down, they continue to rise or go up. Playing the treasury game is a loser, right? Because one, you can't sleep at night, two, it's making your economics of your deal much, much worse. So more is lost by indecision and decision. If you have the ability to rate lock a loan, lock it in, and you can sleep at night. And this kind of leads us to our next question. Josh, where do you see the future? If we have interest rates sky high for the next 2 years, 3 years, 4 years, how does the future look? Because right now it's not pretty. Is it going to get worse? What is your prediction over the next 12 to 24 months? How do we come through this?
I think it gets worse before it gets better, but the silver lining, something you touched on before, is the supply story is tight. It's probably going to get tighter overall. A lot of projects are getting shelved. Some are deciding to build through this, but at the same time, I think that is the opportunity, that the supply is going to be very, very tight. I think that we didn't really touch on the office market and the fact that
we should.
One of the largest asset classes within real estate is at a point where it's not to say there's not going to be any office market, but every city has the Class A building and then everything else. And it's a huge problem. It's a huge problem for tax revenue on cities. It's a huge problem for just cities in terms of life and retail around it and apartments. So that's one of the biggest challenges. We've touched on a lot of residential.
Yeah, we should touch on office.
But offices, pension funds, endowments, core funds, they hold 30-40% in office, and many times their allocation in real estate. So that's one of the, I think, biggest challenges overall.
And then all these CMBS office loans that are going to come to fruition, and there's not there's no lenders for them now, so what do you think happens? They're going to kick the can down the road? What is the solution for those guys coming to refi and can't refi? And then, I want to call the same question on the multi side, but Josh, do you want to just talk about office and what in your opinion, what's going to happen when this trillions of dollars of CMBS loans are due? And these offices are 40% vacant, 30% vacant. What's going to happen to these loans? Do you see banks foreclosing like crazy? I don't. What do you think is going to happen?
Well, I mean, one of the things we started to see in the third and fourth quarter was that institutional sponsors, started to hand over the keys, and that gave cover to everyone else. So when Blackstone and Brookfield start handing over keys, the institutions, the middle market, everyone sort of has that cover.
They made it vote. They made it cool because if the big boys are giving back keys, then all the little boys can give back keys.
So the banks don't generally want to take the office, and the borrower doesn't want to put in more equity because they're overexposed. So I think the way a lot of this probably will get solved is something that we saw in 2008, 2009, where the loan is split into an A and a B, and there's a point in the capital stack where new money can enter the capital stack, and lenders have to subordinate. It's probably the most likely outcome. The big question is what point in the capital stack will that money come into, because values are still in flux. We don't know what an office absorption is going to look like. We don't know what it's going to take to get a tenant in from a TI perspective. Fortunately, we have less than 2% in office, thank God, but people are really hurting, and it's taking a lot of liquidity out of the system. So you have a lot of our peers in credit funds, debt funds, insurance companies that the liquidity, they may look like they have liquidity, but it's being reserved for taking loans off of a repo facility, or future funding commitments, or money to deal with office. So that's a huge challenge globally right now.
But again, like that movie Too Big to Fail, I think the banks know that if they start foreclosing aggressively on office, they can just collapse the entire economy. Yisroel, 2 years ago, people were buying deals at 3.5 caps. It was so mashiga. And then they were taking high-octane bridge loans. You were a bridge lender, you are a bridge lender. And those deals are now trading for 5.25 caps. Interest rates are through the roof. How do you see it? You've got a book of business out there. What is your view? Are you going to be taking back buildings, God forbid? But how are you going to look after your loan book? How are you going to service your loan book if the value they said they bought a $100 million property in 2021, that property is valued well below what they paid for it, and you've got an 83% loan.
Yeah, so that's definitely a focus of ours on the asset management side, kind of our loan book. What's something, Henry tends to go on a tangent. I think the first question was kind of what's going to happen in the next 2 years. I do
Very
think
fluid, we move around.
I do think volume is going to have to pick up by virtue of debt maturities that are coming, and that's Josh mentioned the office side, but even particularly on the multi side, I think there's something like $8 billion of debt that's due within the third quarter on the multifamily side, and then looking at 24 and 25, it's almost $50 billion of bridge loans that have maturities. And so for us, obviously that on the one hand that'll bring potential transaction volume and opportunity for many people to take advantage of. But on the asset management side, and as a note holder, as a lender, I mean, that's certainly an area of focus of ours. I mean, it's if not weekly, a daily conversation. Managing every aspect of our loan book. For the most part, I mean, there's been zero defaults, and so people have that rent growth and interest rate caps and interest reserves have allowed people to stay current. But we're certainly going to be taking a proactive role in helping facilitate borrowers, find a solution, whether it means additional capital in the form of pref and mezz or, some kind of way to convert potentially to fix. I mean, us, Harbor Group International, coming into this year, we were about 70% fixed and 30% floating across our equity book. Today, we're about 90% fixed, and we really moved every single floating rate loan that would size appropriately, cash flow or even cash flow positive, to fixed rate financing, even at what's called quote unquote elevated interest rates. And so we're obviously managing the book and paying close attention, and really the key is being proactive, with borrowers, with potential lenders, with potential buyers, to kind of reach solutions, for anything that may be below our value.
So it just seems like it's a very collaborative time for both of you, working hand in hand with your borrowers. It's not a nasty time, it's a time to work together and find solutions. Morris, so what I'm mostly busy with at Newmark is what Yisroel mentioned, is taking out my floating rate borrowers and putting them into fixed rate borrowers by building a unique cap stack, be it agency, Freddie, Fannie, fixed rate 5-year, 7-year, 10-year, and then putting on top of it pref equity, finding the so-called rescue equity, which I think is nonsense. I don't think rescue equity really exists. Is that what you're busy with? Is that what you think our next 3 years of our life is going to be?
Yeah, I think ultimately what we find is there are deals where that need to happen, right? So a lot of our clients are not necessarily opting to switch from floating to fixed and bring in mezzanine debt. The subordinate debt cost today is somewhere between 11 and 15%, and a lot of people just can't stomach it. So we're seeing those kind of capital stacks come together more so on acquisitions, less so on refis, unless there's a hard maturity. So we recently worked on a multifamily deal in Chicago that had a floating rate bridge loan on it. They executed the renovation plan, and we had an option to go with agency plus pref. Ultimately, we were able to find a CMBS lender to just get a little bit creative, do a rate buy down, and really stretch to take out the whole thing on a single source execution. So there's again, like I said before, it needs creativity. Every deal kind of takes 2 or 3 times the amount of work, and you really got to put your yarmulke on and think about it. But you know, that's how it is.
Final question, gentlemen. And this has been incredibly insightful and really fantastic conversation. If you could close your eyes and talk to your younger self, what piece of advice would you give him, knowing what you know today, seeing what you've seen today? What would you tell your younger self if you had the opportunity to have that conversation? Josh, I think as the most senior member here, I think you go first. You don't have to close your eyes, it's not an exercise, but if you could tell anything to a young Josh Zegen, what are you telling him? Okay. Morris.
I'm still young.
That's what you're going to tell him, you're still young?
I mean, I don't want to list all my regrets, but I think having discipline and being focused is important. Knowing what your specialization is and just sticking to it and just continuously going regardless of market ups and downs. And I think that's the message for today is, yes, the market's down, but it doesn't mean that the business doesn't exist. Business exists. Maybe there's 50% less business out there, so you got to just work twice as hard to bring home the same $100.
Yes. Well, Josh thinks, what would you tell a young Yisroel Berg if you had the ability to have a conversation with him? What advice would you give him that you know now that you didn't know then?
Don't answer a London Green email. No, I would say, Morris kind of hit the point on the head. I mean, I would say just stay disciplined and follow the fundamentals. Like, the reality is, things were too good to be true. Things that tend to be too good to be true are too good to be true. And if you're disciplined, follow the fundamentals at your specific expertise, that'll kind of take you through. And so it's today in the multifamily space, pay attention to trends and interest rates. And it used to be, 10 years ago, if you underwrote a deal and you assumed a lower exit than going in, you get fired over it. And obviously, for about a 10-year period, you're almost stupid if you didn't. And so that's obviously changed, and focus on cash flow and fundamentals. And I think if you stick to that, you'll kind of muscle through whatever comes in.
Have you thought of a conversation? Have you got nothing to say to your younger self?
I thought of that. I think diversification is very important, whether it's national diversification, product type diversification, not too much money in one deal. I think that, where we've had an issue is sometimes in a bigger position, and it can impact other things. And I remember when we first started, we were very New York centric. In New York, everyone thought New York was unstoppable, it was no risk, untouchable. And the reality is politics and things kind of play well beyond your expectations. So diversification is very important.
Even though I'm on the moderator, I'm going to answer this question. I would tell my younger self to always have courage, that if you see someone you want to go talk to, you think business is there, don't double guess yourself, don't question, make the approach, have the courage, because rejection is part of life, and if he slams the phone down to you or tells you he's not interested, so what? You move on to the next guy, but never not have the courage to go and make that approach. Gentlemen, thank you very much for being here. Thank you for coming out to Shanghai. We appreciate it. Have a good night.